Hi, Andrew Bell here with you. Doesn't it feel like it's shaping up to be the fastest year ever? Here we are rapidly approaching the end of the first quarter. And I know some people who've only just put their Christmas tree away. Okay, they've been a bit busy and couldn't get around to it fast enough, but that seems to be the world we're living in now. You may have noticed that our e-newsletter template has changed slightly, and that is to accommodate 3 additional rows of tabs to address some of the additional activities that our company has been receiving significant amount of inquiries on, such as US sales and property management, careers, and great investment opportunities that are surfacing through our property management portfolio. Take a look when you've got a chance. As I mentioned in the last e-newsletter, we're stepping through the main features of this year's annual property report, and today we're looking at the second fundamental, namely interest rates. Monetary policy, or official cash rate, is the main driver, or the main leverage of the macroeconomic management, and is determined by the Reserve Bank. Now, the Reserve Bank's primary objectives are threefold: to control inflation within the 2 to 3% band, second, to stimulate economic growth, and third, to create employment, all important. These are the 3 vital components to the strength of our economy. Through its effect on mortgage interest rates, the cash rate is one of the most important determinants of housing demand, which we know at present that the Reserve Bank wants to stimulate to create new housing construction. And that will only happen through housing demand. Obviously, housing is very sensitive to interest rates. If the cost of borrowing to fund a purchase of a house falls, then this stimulates buyer demand, and vice versa. So what happened in 2013? Well, there were 2 further 0.25% drops in interest rates. That makes 7 cuts totaling 2.25% since 2011 and in the current cycle. Our last movement was a drop of 0.25% in August last year, and our current cash rate is 2.5% and the lowest in 50 years, as the graph on screen shows. The Reserve Bank was happy for some real estate price growth after 7 years of price falls, but they said they will not tolerate unsustainable price growth. Because they have clear objectives to drive the Australian dollar lower, raising interest rates would only increase the dollar value. But the Reserve Bank has said that rising property values is having an ever-increasing impact on rate deliberations. For those who think that the Reserve Bank's hands are tied, that is not necessarily the case, as they do have the option of macro-prudential limits on mortgage lending, and I'll touch on that in more detail in a couple of weeks. So what are the considerations for the next movement in interest rates? Well, first, the Australian dollar, which are hovering around the 88 to 89 cent range. The Reserve Bank still wants the dollar around 85 cents. That would be a temptation, therefore, to drop interest rates to lower the Australian dollar, but unlikely because of real estate prices being stimulated. Unemployment, that's been rising. Again, the temptation would be for the Reserve Bank to drop rates. But again, there is an issue of overstimulating real estate. Housing construction, certainly the Reserve Bank wants to see housing construction increase. It's only done so modestly to date, so again there would be a temptation to drop interest rates. Housing prices, they've been rising at reasonably acceptable levels in most places in Australia other than Sydney, which has gone through the roof. Increasing interest rates would therefore be a temptation to rein in unacceptable price rises. Business confidence, it's been improving, but it's very fragile. So the Reserve Bank wouldn't want to increase rates on that front. And consumer confidence, yes, it is higher, but also fragile. We haven't seen significant enough improvement in the economy for consumers' confidence to be strong. There's also nervousness about how tough the upcoming budget may be. No reason for the Reserve Bank to increase rates on this front. And finally, inflation. A surprising, if not scary, outbreak in the last quarter of last year that would most definitely see the Reserve Bank wanting interest rates to rise. But was that just one-off factors of government costs that had spiked? They will want to wait and see what happens with the next quarter before moving on inflation. So what does lie ahead on the interest rate front? We are either at or nearly at the bottom of the interest rate cycle. There are 3 camps of thinking. One, that rates will not fall any further and will remain at 2.5% throughout 2014. That is where the majority of thinking is. Second, some expect that rates will be about 0.25% higher at year's end. That is not out of the question, and that is where perhaps the second largest group of people are thinking at present. And the third group is that a couple of our major banks had forecast that interest rates would fall perhaps in the first half of this year, but most now expect that is out of the question. The Reserve Bank Board minutes have indicated rates will remain unchanged at 2.5%, but did say that if there was a significant deterioration in our economy, that they would not close off the possibility of additional cuts. I think we are now going to be living in a low interest rate environment for several years, but rates are likely to rise modestly as the Australian dollar falls and/or as inflation rises. The economy is in a neutral zone with no significant signs of deterioration or improvement, so there's no particular reason to adjust interest rates significantly. Perhaps the wild card is inflation. If it does show another quarter at the high end of the 2 to 3% zone, as shown here on the graph, then I would think that the Reserve Bank may think about an upward movement in interest rates. There is no question that interest rates have been the major driver of the real estate market over the last couple of years, but it's unlikely to be the most predominant of the 5 fundamentals over 2014. Others within that grouping of 5 are likely to have a greater impact. And in our next e-newsletter, we will look at the third fundamental, being unemployment. There is no question that this is one of the most significant drivers of real estate sentiment during 2014. Well, that's it for this week. Thanks for your time. Look forward to seeing you in a fortnight's time.